This lesson is going to dive into Wyckoff theory, and we're going to look first at the fundamental law of supply and demand. This applies throughout everything in the world, not just in markets. When you're pricing anything, all that matters at a fundamental basis is supply and demand. If demand exceeds supply, price will go up. If supply exceeds demand, price will go down. Supply and demand, in the context of markets, is what creates support and resistance. But it's very important to distinguish supply and demand is not the same as sellers and buyers. Supply and demand is the intent, it's passive. Sellers and buyers are active and aggressive. So I'll explain that now. Let's take it back to the lesson from before, where I talked about limit orders and market orders. Very basic. One of the first lessons you go through, the order types. If you place a limit order, you are passive. You are putting it on the books and you are waiting for it to get filled. That is supply and demand. If you place a market order and you want to get filled right away, and you don't care what price it gets filled at, you're an active, aggressive participant, you are a seller or a buyer. That's the difference. Supply and demand can only stop price. And this is a very common misconception. Supply and demand can only stop the price from moving. They cannot move the price. So you might think of a whale with a big order or a smart money or whatever. If they have huge orders sitting there, that cannot move price. That can only stop the price when it gets there. Only sellers and buyers can actually move the price. The price can only move through somebody actioning a market order for the price to go up or down. It's important to understand this because there cannot be a market without a buyer and a seller. You can't place an order without having what's called a counterparty. So if you want to place a buy order, there has to be somebody on the other end for a sell order. One of you will be passive, one of you will be active. That's all the way, all throughout the markets. Let's look at it on the order books. So you'll see this on your exchange. Very simply, the bids are below, the asks are above. Asks are in red, that's where people want to sell. That's the amount of Bitcoin that they want to sell at each level. There's the amount of Bitcoin that people want to buy at each level here. But price is in between these two levels. So for price to move up one level, for it to go up another dollar in value, the buyers must purchase these 6.193 Bitcoin on the market with buy orders. Or for price to go down a dollar, sellers must consume those 19 BTC that are there with market sell orders. That's it. That's how the market moves. Very, very simple. Now, to think of it in a little bit of an expanded view, you also have to consider price that can move through a lack of interest. It's not always fixed. As I'm sure you'll have seen if you've ever looked at an order book, it changes every second. These orders, if I go back and look at the order book now, they won't look the same. Price is constantly moving and the orders are constantly moving. So the absence of either supply or demand can force a price movement. Think about it in real terms. In the real world for you, what's a good example? Oil. Let's think about oil. What happens when Saudi Arabia decides to cut production of oil? Price spikes, doesn't it? They put out an announcement saying we're going to reduce the amount of oil we're producing and the price of oil shoots up. But nobody bought extra oil when they announced that. So why did the price go up? Because supply was reduced. So an absence of supply will help the price rise the same way that an absence of demand will cause it to fall. So you'll get certain points in the market where it just seems to drift slowly up or slowly down. That's the area, and those are the areas I'm going to help you identify to avoid trading because there's not a clear signal in them. The absence of demand or supply will cause price to move because it will just take far less of a market order to move it. It still has to move with a market order. This law remains concrete. Only a seller or a buyer can move the price, but if you have less demand or less supply, it can move easier. What might have taken a 100 BTC order, if it's a market with a lack of interest, you might see a 10 BTC order able to move price the same way. So how do we measure supply and demand? On different timeframes, you can actually measure it in different ways. So on a low time frame, which is on a minute-by-minute basis, you can measure it through order flow and harmonic divergence matrix. On a mid time frame, that's hours or days, you use the harmonic divergence matrix. And on a high time frame, so over weeks or months, you look at complete price action structures. So order flow is the live reading of buying and selling coming into the market. It's also known as the tape. It's where you watch orders getting executed in real time. And at certain points, you can use that to identify if there's an overflow or an imbalance between supply and demand. This is suitable for scalpers and day traders. It is not necessary for you to learn this to be profitable in the markets. It's a very advanced concept. It's a concept that will be taught in later lessons if you want to get there, but it's not something you need to worry about at the beginning. The harmonic divergence matrix
is a tool that I have created myself personally based upon the third law, which you're going to find out about in a later lesson. The third law, which is effort versus result. So this is law 1, supply and demand. The third law of effort versus result dictates and shows how the interaction between price and volume is the most important determinant for, is a market going to go up or go down, which is essentially just supply and demand, right? Keeping it simple, supply and demand is the best way of estimating will the market go up or down. The harmonic divergence matrix will help you do that on all time frames, but most relevant on the middle time frame, the hours to days. And then on a high time frame of weeks to months, this is when you look at complete price action structures. When you look at a weekly chart or you look at a monthly chart and you see a long trend or you see a lengthy consolidation, a range, whatever it may look like, through the principles you'll learn by learning both Wyckoff theory and general market structure, you will be able to identify supply and demand purely through the charts and then supplement it with other things such as volume and the interaction of volume and price through the harmonic divergence matrix. So that's an overview of supply and demand, what it is, why it exists, and exactly how we are going to measure it. In future lessons, each of these will be covered in depth. Don't worry, at the moment we are dealing with the theory, we're dealing with the 3 laws, but you must understand and always remember that in every single market, law number 1 is supply and demand. Keep that front of mind, because as you go through any market, anything that has a chart, anything that can be bought or sold, it doesn't even have to have a chart. It can be the housing market, it can be watches, it could be anything at all. If there is not a willing buyer for what you're selling, you will not sell it at that price. However, there's a saying, everybody has a price. So does everything. So if you wanted to sell your house for $500,000, nobody wanted to buy it, you could either say, okay, I'm not going to sell my house, or if you really needed money and you wanted to sell it, you would incrementally drop the price until you find a willing buyer. So it is not enough to just say, I have this thing and I want to sell it, or I want that thing and I'm going to buy it. The interaction of both the price and the intent of the buyer or seller, where they come together, dictates the supply and demand. And then when you take that across an entire market for all the thousands and millions of buyers and sellers, that gives you what we see on the charts. So don't get caught up in the news, in the narrative, in the hype, any of those things you see, the reasons why people are telling you it goes up, why it goes down, where it's going to go next, crazy price predictions, or people saying that the market's about to crash. Ignore it. First of all, stick to your basics, your fundamental law. What is supply and demand telling me?
So remember supply and demand. Keep that front of mind, because that's the cornerstone of Wyckoff theory and why these accumulation and distribution campaigns begin. So that's what we're going to go into now. Next lesson takes Wyckoff to the next step. Accumulation and distribution campaigns, how they look, how to spot them, and a really interesting point about how not always is it what you think.